Saving money, the age-old struggle of finding the right balance between your living expenses, spending money for that new piece of technology that you just have to have, and then putting money aside for your future, which frankly isn't all that fun. But whether you're saving for a large expense such as buying a new car or saving for a down payment on a new home, I know just how hard it can be to save money on a consistent and regular basis. Luckily though, I'm here to tell you that your mindset behind saving money can easily change, and the act of saving money can even become somewhat addictive if you look at it from a different perspective. And I'd like to share with you my mindset behind saving money and some of the different techniques that I've used to save up roughly $20,000 in the last 6 months of saving. Now I do realize that for some people, $20,000 in 6 months might be a lot, or for some it might not be a lot at all. But either way, the amount of money that you are able to save will be directly related to your after-tax income, your allocation of money for different expense categories, and then finally staying consistent with your contributions to your saving goal. And once again, I know the topic of saving money can be super boring, so I'm gonna try to make this as fun as possible. So without further ado, let's get into the video. I'd like to start off by talking about money allocation per expense category, because this is gonna represent one of the key elements to the foundation of your savings goal. Now, the first thing that you absolutely have to do is look at your income and set a budget. Yes, I said it, a good old budget is the first step to success in savings. Setting a budget for your monthly expenses based on your income is critical to your savings goal, because without actively tracking where your money is going to each and every month, you're not going to be able to effectively contribute on a consistent basis the amount of money that you would so desire into your savings account or your registered savings account. It's also extremely easy to just spend money freely when you don't really have a tracking system for where your expenses are actually going. So I personally divide my expenses into 5 different categories, and I suggest that you do the same. Each of the 5 categories have a different weight associated to them based on my after-tax income, and some of the categories I allow myself to go over each and every month, and some of the categories I try to stay under every single month. So the first expense category is called living expenses, and I try to keep all my living expenses under 55% of my after-tax income per month. This is by far the most broad category that we're going to be looking at today, and it covers everything from rent, cell phone, Wi-Fi, heating, food, transportation, basically all expenses that contribute to your current lifestyle. And for most people, including myself, keeping all your living expenses under 55% is extremely difficult to do. I do realize that. However, if you're able to do this and keep all your expenses under 55% of your after-tax income, I can assure you that reaching your savings goals is going to be a lot quicker and a lot easier to accomplish. In addition to this, the contributions that you will be able to make to your savings goals are going to be a lot higher and will therefore have a much larger impact in the long run. The second category here is called rainy day fund, where I contribute 5% of my after-tax monthly income. This is essentially a savings account that I keep with Wealthsimple's 2% savings account, where I contribute on a monthly basis 5% of my income, with the goal in mind that I will not ever be touching this money unless I really need it in the case of a financial emergency. It's pretty much there for if I desperately need it someday, and by contributing only 5% of your income every single month, you really don't notice it all that much coming out of your bank account. As a rule of thumb, everyone should pretty much have at least 3 months of living expenses saved up in a rainy day account, all the way up to 6 months or a year if you really want to be safe. So for example, if your living expenses are $2,000 per month, you should have at a minimum $6,000 saved up in your rainy day account. The third category is called savings and investments, where I try to contribute at a minimum 25% of my after-tax income. Now personally, I split this 25% of my income contribution to a TFSA account and then a smaller portion to a 2% savings account with Wealthsimple. The reason here is that I want to mitigate my risk between having money actively invested in the market and then a smaller amount that's just sitting in a 2% savings account, because I'd like to mitigate the risk of having short-term large fluctuations in my capital due to the fact that I'd like to buy a property in the near future. My logic here is that the money I put into my TFSA account will most likely grow at a much larger rate than 2% annually, because I have that money actively invested in different ETFs tracking the American stock market. However, I do still want to have a smaller percentage of my portfolio in a savings account and invested in bonds that'll have a much lower chance of having short-term fluctuations. If you'd like to know more about my strategy behind index fund investing, I made a really good video about index fund investing for beginners that you can check out right here. Now, the fourth category in my expenses is called fun, and I contribute about 10% or less of my after-tax income. And yes, I said it, you can still have fun while saving money. In fact, saving money is more fun all around, because the money that you do end up spending on fun activities is money that you can actually afford to put into those activities without compromising your future. For me personally, fun includes money that I put into a savings account towards a vacation that I'd like to go on, and then also anything that's like restaurants, activities, and shows, anything like that contributes to fun. Finally, the last category for my expenses is called education, where I count things like Spotify for podcasts, any types of books, audiobooks, and pretty much anything that's going to contribute to my financial education and pretty much education on any other topics that interest me. This category represents 5% of my monthly after-tax income. I find it extremely important to put money every single month into your personal education, especially since I already graduated college. You need to consistently be learning new ways of thinking and techniques to reach your goals. Pretty much every time I purchase a new book or I dive into a book that I previously purchased, I learn a new piece of information that I can apply to my life that'll pay dividends in the long run. Now this brings me to my second point in saving, which is cutting back your expenses so that you can have your living expenses be under 55% of your after-tax income. Now I do realize that this is probably nothing revolutionary and you've probably already heard this before, but just simply taking 30 minutes to go through your credit card statements for the last 3 months is going to be really eye-opening as to where your money is flowing to every single month. Before I personally had the mindset of trying to hit the 55% rule, I didn't even realize where my money was going to, and once I started looking at my credit card statements, I pretty much realized that I was spending money every 2 weeks on clothing, going to restaurants multiple times a week with my friends, and pretty much just tons of expenses that in the long run really build up even though you don't realize it in the short term. And in the big picture, if you actually have a savings goal that you're trying to hit for a specific reason, cutting back on these expenses that are not contributing to your well-being and your financial goals should be something relatively easy to do, because compromising for a bigger goal is a lot more rewarding. And just a quick little example here, a $4 cup of coffee from Starbucks in the short term, so on a daily basis, doesn't seem like all that much. However, if you multiply a $4 coffee by 30 days in the month, that represents $120 per month spent on coffee alone. And on a $50,000 a year salary in Canada, for example, that represents 5% of your monthly after-tax income. 5% of your income on coffee is not a good way to hit your 55% expense rule. So this brings me to my third point, which is actually have a savings goal in mind and then consistently contribute to that goal, even if it's a small amount every single month. Setting up automatic deposits into your account is a way that you can consistently contribute an amount that suits your budget without even thinking about it. The first step in any savings or investment goal should be to pay off any single high interest debt that you have, like credit card debt, for example, or pretty much any debt that is over 12% interest. Step number 2 is going to be cutting back on the useless expenses that you have every month to hit that 55% goal. Then just simply calculate 25% of your after-tax income and set that up as automatic deposits into your savings or investment account. By setting automatic withdrawals out of your checking account into your savings or investments account, this is going to take out all the stress of reminding yourself that you need to contribute on a consistent basis. And in the long run, this is going to help you foster a savings mindset because it's just going to be an automatic part of your financial goals. Soon, saving money and investing it is just going to be a normal part of your finances, and you're going to thank yourself in the long run because you're going to have a nest egg of capital for any one of your large expenses, or if it's just for a long-term savings or retirement goal. The next tip I would recommend is to take advantage of saving your money in a registered investment account, such as a TFSA if you're Canadian, or a Roth IRA if you're American. These accounts allow you to earn interest and capital gains on your investments on a post-tax basis, meaning that the nest egg that you put into that account will grow over time at a tax-free basis. So when you withdraw the funds from the account, you will not be paying taxes on that amount. Taking advantage of a registered investment account is super important to hitting your financial goals, and I highly recommend that you check out the video I made right here, basically outlining all the technicalities of a TFSA account. The video covers topics of how a TFSA account actually works and what your contribution room would be based on your age as a Canadian, so I highly recommend that you go check it out. So to summarize the material that we just covered, saving money towards your goals is not actually all that difficult if you have the right mindset and you use the right techniques to do so. The first step to success is budgeting your income based on different expense categories. The second step to success is looking at your credit card and debit card statements and cutting back on expenses that are keeping you away from your savings goals. The third step is going to be paying off any high interest debt that's over 12% annually and then having a really clear savings goal in mind that you can contribute to on a consistent basis. And finally, take advantage of a registered investment account, either the TFSA in Canada or the Roth IRA in America. I'm not sure if there's any registered accounts in other countries. However, if you are from another country, make sure to look into this because it's a really good way of growing your money tax-free. And that's pretty much it for today's video. Self-discipline combined with these 4 steps are gonna really put you on the right track towards your savings goals, and hopefully you'll be able to thank yourself in the next 5, 10, or 20 years because you're gonna have a saving and investment mindset that's gonna pay dividends in the long run. If you enjoyed this video and it helped you out, make sure to give it a like and subscribe to the channel. I post videos on a weekly basis talking about personal finance, investing, savings, and pretty much anything else related to business that interests me. So thanks again for watching, and I'll see you in the next video.